For most of today, I was actually outside the RBA headquarters in Martin Place waiting on that decision. And just after it dropped, I caught up with Jarek, Kowcza, economist at St George Bank.
Yes, it was. That's right. The RBA did increase the cash rate today to 4.35%, which is the first increase in 5 months following a period of 4 pauses over the last few months. And as you mentioned, it was an expected hike. We did see that 29 out of the 32 economists surveyed by Bloomberg were expecting a hike today, and financial markets were also well priced for a hike, with about a 60% chance of a hike today, and that's ultimately what the RBA delivered.
Oil prices, they've been high, rents keep going up. Are these two of the big things that the RBA has no control over? Is that why one of the reasons why inflation remains stubborn in Australia?
Well, there's actually a number of reasons why inflation is remaining sticky, and one of the key reasons why the RBA hiked rates today is that we did see during the September quarter that inflation was stronger than expected, and as a result, that means that the path of getting inflation back down to the 2 to 3% target by the end of 2025 is likely to prove a bit more bumpy and require a bit more monetary policy tightening from the RBA. Now, as you mentioned, there are things such as oil prices which are impacting inflation, but it's not just the external factors that are actually impacting inflation. If we split inflation into goods and services, we can see that services inflation, which is more impacted by domestic demand and domestic supply conditions and domestic conditions in the labour market, has been proving to actually be a bit sticky, as we've seen overseas, and there is a risk that it might be sticky here in Australia as well. So there's a lot of domestic factors that are playing into the inflation story, not just the international factors.
What about next month? Do you think the Reserve Bank may need to lift rates again?
So if we think about what financial markets were pricing ahead of this meeting, they did have a chance of another hike, but it was later on next year. So the markets were priced about 50%, or had a 50% chance for one more hike through 2024. So we do think that the risks are probably tilted to the upside for inflation if inflation does prove to be more sticky than expected. But we don't expect that as our base case at this stage. So the RBA has been quite data dependent over the last few meetings, and given that they've hiked rates today, they're likely to want to see how the data comes in over the next few months before they take another view of whether rates would need to go higher. But we did see that commitment to getting inflation back to the band in the RBA's statement today, and they did maintain that tightening bias that we've seen in recent statements. So we're certainly not out of the woods yet when it comes to inflation or potentially further cash rate hikes.
And when could we potentially see the cash rate start to go down?
So it really depends on the path of inflation and when we see inflation coming back down. So if we do get that progress that we're expecting through 2024, and if it looks like inflation is coming sustainably back to that 2 to 3% target into 2025, then the RBA may be in a position to cut rates towards the end of next year, perhaps in the third quarter of next year, or maybe even a little bit later. But it really does depend on how the data flow plays out and how sticky inflation proves to be.
Jarek, Kowcza, thanks for your time.
Thank you very much for having me.